As the U.S. markets are closed for the weekend, Tilray Brands, trading under the ticker TLRY, last finished its session on Friday, October 31st at $1.34. This represented a notable move for the day, closing up 3.88% or 5 cents per share. But as with all things related to this company, that simple closing price tells you almost nothing about the real story. The real activity isn't just in that end-of-day tick, it's in the immense, underlying structural data that most investors miss. For instance, the sheer volume of off-exchange trading, which exceeded 56% of all trades on the final day of October, and the significant fails to deliver data from just a few weeks prior, where nearly 8 million shares failed to settle. This suggests a far more complex and contentious battle is being waged in Tilray than a simple line chart can ever show. The common expectation for Tilray, the one that has held investors captive for years, is that this stock is a simple leverage bet on North American and European cannabis legalization. The narrative is that as the dominant Canadian player by revenue, and with a significant EU GMP-certified medical footprint in Germany and beyond, Tilray is perfectly positioned to capture the global market the moment politicians give the green light. The acquisitions of craft beer brands in the U.S., like Sweetwater and Montauk, are seen as a clever Trojan horse, building a distribution network that's ready to flip the switch and push cannabis products the second federal law allows it. That's the expectation. But the reality of how this stock is trading today and why it's sitting at $1.34 is a much harsher, more immediate story. The market is no longer patiently trading Tilray on a distant promise. It is impatiently trading it on its recent volatility, its balance sheet, and the massive, conflicting pressures from both institutional short sellers and a deeply divided retail community. Let's first look at the recent movement, which has been nothing short of whiplash-inducing. This is not a stock for the faint of heart. Recent trading days have seen volumes over 100 million shares, a staggering amount for a stock at this price. This tells you it's one of the most actively debated and traded names on the market. While the stock is technically up a couple of percent year-to-date, it's also down over 40% from its 52-week high, a high it touched after its last earnings report. But in a perfect illustration of its volatility, it's also trading nearly 300% above its all-time low set earlier this year. This is the profile of a stock being pulled in two directions, acting less like a stable consumer packaged goods company and more like a high-stakes sentiment proxy for the entire cannabis sector. The most fascinating part of this recent action was the reaction to its first quarter fiscal 2026 earnings, reported on October 9th. By all accounts, the report was a blockbuster, at least against the bleak expectations. Tilray posted record first-quarter net revenue of nearly $210 million. More importantly, it shocked analysts by reporting a positive net income of $1.5 million, its first profitable quarter since 2021. And perhaps most critically, it announced it had slashed its net debt down to just $4 million, a massive improvement in its balance sheet health. The expectation was that this would be the report that broke the bearish thesis. The reality? The stock popped, hit that 52-week high, and has since bled out over 40%. This is the central conflict. The company delivered fundamental improvement, but the market, for whatever reason, either doesn't believe it's sustainable or is more concerned with other factors. This brings us to the elephant in the room, and it's a topic every Tilray investor needs to understand: the short-selling pressure. This isn't a vague conspiracy. It's a verifiable, data-driven reality. As of the last report, over 104 million shares of Tilray are held short. That translates to roughly 9.36% of the entire public float. That is a significant, calculated institutional bet that this stock is going to go lower. Now, what is the short thesis? It's not just a simple bet against cannabis. The argument from these funds is likely rooted in a few key beliefs. One, that the company's massive beverage segment, built from acquiring brands from Anheuser-Busch and Molson Coors, is a costly and low-margin distraction. Two, that any U.S. legalization, particularly a Schedule III rescheduling, will primarily benefit the U.S.-based MSOs, or multi-state operators, not Canadian players like Tilray, who are still locked out of the market. And three, that the company's history of shared dilution to fund operations and acquisitions will continue. What's your take on this heavy short interest? Is it smart money correctly identifying long-term risks, or is it coordinated pressure holding back a company that's finally turning a profit? But here's where we need to look at the data responsibly. Many retail investors see a high short interest percentage and immediately think of a short squeeze. For Tilray, that's a very risky assumption. The days to cover, a metric that tells you how long it would take for all shorts to buy back their shares based on average volume, is only 1.69. That is an incredibly low number. With the stock's massive daily volume, shorts can get in and out with relative ease. There is no liquidity trap here. Furthermore, the cost to borrow the shares to short them is currently very low, at only 1.4%. This means it is not expensive for funds to maintain these negative bets. This combination of a low borrow rate and low days to cover suggests that this is not a stock on the verge of a forced technical squeeze, but rather one with a deep-seated, fundamental disagreement between bulls and bears. For investors, this means you must be able to track this data yourself. You can find short interest percentage and days to cover on public sites like NASDAQ or data providers like Fintel. It's also where you can see the fails to deliver data. That spike to nearly 8 million FTDs in September is a legitimate red flag, as it can imply issues with settlement or perhaps naked shorting, but it's not a smoking gun on its own. What it does confirm is that the plumbing beneath this stock is under extreme stress. This is not a coordinated attack. It appears to be a fundamental, high-stakes debate. So if it's not just a legalization play or a short squeeze play, what is Tilray Brands as a company today? The management team, led by Irwin Simon, would tell you it's no longer a weed company. It's a global consumer packaged goods company that just happens to have cannabis as a major vertical. The business is now split into distinct parts. You have the cannabis segment, which is number one in Canada and a medical leader in Europe, recently announcing an expansion of its premium craft flower offerings in Germany from its EU GMP facility there. You have the beverage alcohol segment, which is now a top 5 craft brewer in the United States and is already being used to expand internationally, with a new initiative to bring its craft beers to Japan. You have the distribution segment, a significant revenue driver in Europe. And you have the wellness segment, anchored by the Manitoba Harvest brand. This diversification is the company's core strategy. The beer is not beer. It's placeholder for a future where those same trucks and distributor relationships can be used to move THC-infused beverages across the United States. This strategy is also the source of the deepest division in the retail investor community. If you scan the discussions on Reddit or X, you find two very distinct, frustrated camps. In one corner, you have the long-term holders, many of whom bought in at much higher prices and are holding purely for U.S. legalization. They are frustrated with the political delays in Washington and see the beer and beverage acquisitions as a costly distraction. In the other corner, you have a more cynical group that points to the rising share count as evidence of constant dilution, feeling that retail investors are footing the bill for an empire-building strategy that may never pay off. This has created a show-me market that was not even satisfied by a profitable quarter. This is a critical point for everyone to consider, and I want you to comment below on this. Do you believe that U.S. diversification into craft beer is a brilliant long-term strategic move, or is it a costly distraction that's taking focus away from the core cannabis business? Looking ahead, the path for Tilray is defined by this tension between expectation and reality. The expectation is that a catalyst will come from Washington in the form of Schedule III rescheduling or from Germany as its medical market fully matures. The reality is that those catalysts may be far less impactful than investors hope. Schedule III, for example, is a huge benefit for U.S. MSOs, as it alleviates the 280E tax burden. For Tilray, a Canadian company, the benefit is indirect at best. It doesn't magically open the border. The real catalysts to watch for Tilray are not political, they are operational. The next earnings report is now the most important event on the horizon. Was the positive net income a one-time fluke, or is it the start of a sustainable, profitable CPG business? Can they show margin expansion in their beverage segment? Can they continue to pay down debt? And most importantly, can they do all this without diluting shareholders further? In the end, the story of Tilray Brands is a perfect microcosm of the entire cannabis industry. The expectation was a fast-growing, high-margin new industry. The reality is a capital-intensive, low-margin, and brutally competitive consumer goods business, further complicated by a patchwork of global regulations. The $1.34 closing price isn't the story. It's just the current score in a game being fought between a company trying to prove its CPG pivot is real and a significant portion of the market that is betting, and betting heavily, that it is not.